Hey everyone, welcome to The Explainer. I'm really thrilled you're tuning in today because we're going to unpack something absolutely crucial in modern finance, market beta. If you've ever looked at a stock and thought, okay, how do the pros actually calculate the sheer volatility and risk here? Well, you're in the right place. Today is all about how market beta measures risk, basically taking all that wild market behavior and turning into clear, actionable numbers. All right, so here's our roadmap for today. First, we'll define market risk. Then we're going to decode the beta scale itself. After that, we'll look at the math behind it, apply it to portfolios and the CAPM, and finally, wrap up with real-world beta estimations. Let's get right into it. Okay, so let's start with a really simple but honestly vital question. Just how risky is your stock? To really get beta, I want you to picture a boat sitting out in the ocean. The ocean's tide, that's the overall stock market. As that tide naturally rises and falls, it takes the boat right along with it. Now, beta doesn't care about the specific design flaws of the boat itself. Instead, it measures exactly how your specific boat reacts to those broader ocean waves. All right, Section 1, Defining Market Risk. This is our macro view of volatility. So, technically speaking, beta is the hedge ratio of an investment with respect to the overall stock market. But the absolutely crucial phrase you need to remember here is non-diversifiable, systematic market risk. Look, when you build a portfolio, you can diversify away the quirky, individual issues of a single company, right? That's idiosyncratic risk. But you cannot just diversify away the risk of the entire stock market moving. Beta is that specific statistic that isolates and measures that inescapable market-wide risk. Moving on to Section 2, Decoding the beta scale. Let's take these abstract numbers and make them actually mean something. Right, so the baseline of our scale is exactly 1.0. By definition, the value-weighted average of all investable assets, compared to a broad index like the S&P 500, is 1. If an asset has a beta of exactly 1, it means that, on average, its returns move perfectly one-to-one with the market portfolio. It's, well, perfectly average in its volatility. But what happens when that number goes up? A beta of 2.0 means an asset is literally twice as volatile as the market. It moves way more than 1-to-1. Think back to that hedge ratio we just mentioned. To fully hedge out the market risk of a stock with a 2.0 beta, you'd actually have to short $2,000 in the stock market for every $1,000 you have invested in that specific stock. That is a wild amount of extra movement you're taking on. On the flip side, a beta of less than 1.0 means the asset is less volatile than the broader market. And, while it's pretty rare for standard stocks, negative betas absolutely do exist. Assets with a negative beta, think put options, short positions, or certain inverse ETFs, they actually tend to go up when the market goes down. They move inversely to our ocean's tide. Let's ground this in the real world for a second. On the high beta side, you've got instruments like call options, moving super aggressively with market trends. Then, on the low beta side, you've got utility stocks. Now, utility stocks behave almost like bonds, right? They pay consistent dividends, and their business isn't massively dependent on the economic cycle. They are still stocks, so they definitely feel the market's pull, but their beta stays incredibly low. Okay, Section 3, the math behind beta. We're zooming right into the microengine now. So, to actually find beta, we use an ordinary least squares regression. But hey, you don't need a math degree to grasp this, just two core concepts. First, you've got covariance, which is just how the individual asset and the market move together. Second is variance, which measures how much the market itself fluctuates over time. To get beta, you simply divide the covariance by the variance of the market. It's basically the ratio of how much they step together versus how much the market steps overall. Another way to look at this math is through correlation and standard deviations or volatilities. The formula naturally uses the correlation between the asset and the market to strip away all the noise. It brilliantly isolates the ocean's tide, that's the market risk, from the specific design of the boat, which is the idiosyncratic risk. That's the real magic of this calculation. It gives you this incredibly pure look at systemic exposure. All right, Section 4, Portfolios and the CAPM. Let's see how beta applies directly to your investments. One of the most beautifully simple things about beta is that it's linear operator. You can weight it, average it, add it all up. If you've got a portfolio that's 80% asset A and 20% asset B, the portfolio's total beta is literally just 80% of asset A's beta plus 20% of asset B's beta. It scales perfectly with your capital allocation. Super clean. And that leads us right into a massive pillar of finance, the capital asset pricing model, or CAP. under this idealized academic framework, beta risk is fundamentally the only kind of risk that rewards investors with an expected return higher than the risk-free rate of interest. When you use it inside the cap, beta transitions from just being a neat measure of past volatility into being the ultimate benchmark for your expected rate of return. So how does this play out when evaluating the pros? Well, we use beta to test fund managers. Think about it. If the overall market jumps by 20% in a given year and a manager holds a portfolio with a beta of 2.0, that portfolio should naturally return 40% based on beta alone. And that's before the manager takes any credit for their stock picking skills. By adjusting for beta, we hold that market risk constant and isolate the true alpha, which is the actual tangible value the manager added.
Finally, Section 5, real-world beta estimations, taking it way beyond just the historical data.
Here's the really crucial takeaway, guys. A realized historical beta, which we usually estimate using an OLS regression over 1 to 5 years of returns, is just one specific version of history. It's a benchmark, but investors don't really want the past, do they? They want the best forecast of the true prevailing future beta. And the thing is, underlying market betas drift. They move over time because a company changes its products, its clients, or just due to pure historical randomness.
Since historical beta is, well, imperfect, financial analysts rely on a whole toolkit of specialized models to bridge those gaps. You've got the Bloom beta, widely used by Bloomberg, which corrects for regression toward the mean by shrinking the historical beta closer to 1. Then there's the Vasicek beta, which uses Bayesian estimation to adjust for stock volatility. And models like Scholes-Williams or the Dimson beta, they exist to correct the math when assets trade infrequently. The whole goal of all of these is to give you a truer picture of tomorrow's risk instead of just reciting yesterday's data. And of course, we have to adapt when the basic linear model completely breaks down. Take derivatives, like out-of-the-money options. They have highly distinct non-linear payoffs. As the price of the underlying asset changes, the option's change in price isn't constant at all. To handle this, mathematical finance defines a specific volatility beta that measures covariance with a correction for instantaneous underlying changes. It really just goes to show that as the market gets more complex, the math steps up and adapts right alongside it. As we wrap up this explainer, I want to leave you with something to really think about. Is your portfolio truly diversified, or are you just heavily riding the market's beta without even realizing it? Now that you understand the hedge ratio, the CAPM, and how to strip away idiosyncratic noise to isolate that systematic risk, you've got the tools to view your investments through a truly professional lens. So evaluate your exposure, check your true volatility, and never forget the math that drives the market.